Good afternoon, evening, everyone, and welcome to our first webinar of 2026 and on a very interesting topic, IFRS. It's fantastic to see so many of you joining us from across the Middle East, Eurasia, Turkey, Azerbaijan, Georgia. A great reflection of your commitment to staying ahead on this very relevant topic. Today's session, key updates and implications will cover the latest IFRS developments and their practical impact on businesses and finance professionals. To make the session more interactive, we encourage you to use the Q&A panel for any questions, and we will take the questions at the end of the session. We'll also be conducting polls during the webinar to make the discussion more engaging. A big thank you to our speaker, Nikhil, and the team and my team who made this session possible. With that, let's get started and explore the key IFRS updates shaping 2026. Over to you, Nikhil.
Thank you, Prerna, and welcome to everybody who has joined here. I was seeing lots of your names pop up as well, and two things. One, of course, brings great memories because teaching some of you 16, 17 years ago, and also makes me feel slightly that old that I've been now around for 17, 18 years. So, but welcome all, and hopefully you can take back something from that session. So let me allow to please share my screen, and we'll get kicked without spending any more time on that. Yeah. So for those who might not know me, just a quick, you can just scan this code. You can connect with me. It would be lovely to connect with you all as well on LinkedIn, and of course, share thoughts, insights, ideas, and of course, learn from you as well. Some of you might know of this topic a little bit more than me as well. So it'll be lovely to interact with you all on this. So to kickstart, and Jay, and if you can just everything, I hope you can see my screen and we can kickstart. Yeah. In terms of what is happening, what's the change, there is a lot of talk about this IFRS 18, and naturally so for those who are listening in, because although from a debit, credit, asset, liability standpoint, nothing has changed. What has really happened fundamentally, if you really ask me, why this is a big change and why everybody is talking about it, is because our traditional IAS 1, which is what the standard, if you ask me, it has started 30 years ago, this IAS 1, the original presentation. Yeah, 30 years, it's ancient than any of us probably even started studying. That is what is changing. That is like the core element of what we all know about, right? Of course, things change like financial instruments, leases, revenue, which is also very critical. But from 2027 onwards, there has been this change or this new standard that we all need to apply called IFRS 18, presentation and disclosure. And what I will try to do in the next sharp 40 to 45 minutes, of course, as a disclaimer, you cannot know everything of everything, but at least you should take back, hey, this is what it used to be. and this is what the new style or the new presentation is going to look like. Of course, there are some nuances with everything. For those who are finance professionals, devil lies in the detail, right? So sometimes certain words, certain definitions, there's a lot more than just a 45-minute webinar. So that's my first note, that if this is something you're implementing, which most of us will, especially at certain challenging levels, you need to do a bit more work as well, which is the starting point of this. At least it gives you that trigger in your mind. So what's the concept of this changing? And what's the, if I always like to think about it, what's the end goal of this? Why is this changing? And what's the purpose of this change? Not just to mug it up, not just to learn, hey, this is ABCD, this is the rearrangement. What is going on? What is going on is effectively the way companies record their operating profits, the way they present and the way they show that is getting completely changed in terms of enhancing the comparability, ensuring that companies around the world, irrespective of kind of businesses they are in, they are recording the similar style of operating profits. So as an investor, if I'm investing in two entities, and this is where the challenge lay, people ended up recording things effectively. They were recording things up and down and residuals and here and there. And as an investor who's traditionally a non-accountant would say, guys, what's going on? I don't understand. Why is an operating profit of this company different from this company, from a third company? I don't understand. So it was on the back of that to ensure, number one, if you ask me, to ensure we have better comparison. And number two, the key reason is a lot more transparency as well, which is what the theme of the standard is. So getting into the real crux of the matter, right? And if you ask me, this is the key change apart from other aspects also, but today's webinar will focus on two out of those three or four key changes. One, the major chunk of it is how is this statement of profit and loss going to look? So if you see on my screen here, and I will try to highlight as and when we go through, and please do listen up carefully on the style and approach that people or the audit firms and everybody who's gone through this is advising. So this is not only my advice. I've done all my research to help you understand how to do this. So this is the face of how this profit and loss will look. On the face of it, there are these 5 headings that you see here, right? 5 headings meaning operating, investing, financing, taxation, and discontinued operations. And I will go through each of these in turn. Now, mind you, some of you who sat there might be wondering, you said, easy peasy, switch it off. I know operating, investing, financing. I do this every day in my cash flow statement. But watch out. Warning for all of you. Although the headings are similar, operating, investing, financing, it does not mean the same what it means in a cash flow. So your concept of cash flow has remained similar with a few updates. We'll talk about that. But I'm saying it is not the same conversation as what I do in a cash flow statement. The definition of investing, financing, operating, and cash flow statement is different from this. So do not equate the same. What is the definition of how these things work? And the best way to put this is, let's work in reverse order. Don't work from the first order bit. That is, don't say what all goes in operating. That's not how the standard teaches us. They're saying, let's see what goes in all the other 4 categories, and then we'll talk about the operating. So let's start with the 5th element that you would see here. What is this discontinued operation? I wish I could, of course, see most of you in my usual classes. I'm always prodding people for those who might know. Discontinued operation, meaning everything linked to their IFRS 5, which is effectively that non-current assets held for sale. You see anything linked with that, not only held for sale, discontinued as well. It's hard to write on the screen, but hopefully you get the idea that there is, of course, anything to do with that selling off, the net results of that, presenting that information separately, which is very self-explanatory. It doesn't change. It was, what was discontinued. We had presentations similar, but not the same. But now there's a separate category called discontinued operations. So this is, for those who might not be aware, IFRS 5, non-current assets held for sale, selling off those major lines of businesses, geographical areas. The information or the results of that are shown in this discontinued. So that is as it is, and everything linked to that goes there. Let's keep going up. The fourth one which you see here is the income taxes. Again, self-explanatory, but well, everything we need must define. Everything linked to taxes. When I say taxes, again, I appreciate some of you might have forgotten the standard numbers. Uh, for my classes, I know people forget the day before. Some of you have done this a long time back, but this includes all the current taxes, deferred taxes, everything linked to that IAS 12 tax element. And mind you, for those in this region as well, we used to be very excited. Wow, there's no deferred tax. But now, mind you, because there's corporate tax, timing differences, there is deferred tax. So you should be happy. You will be a bit more in demand as well. But the tax element is all going in that 0.4. So we're going to build it up step by step. Hopefully that is, and like I said, we'll keep the questions at the end 15, 18, 20 minutes. So you can ask everything that you would want to as well. So you got the discontinued. You've then got the taxes. Now comes the slight challenging elements also, which is, if you ask me, discontinued and tax probably is very self-explanatory. Now let's look at the third category that you see here. The third category that you see here is to do with this financing category. So what's this financing category? Let's have a look. Two aspects go in this financing as per the definition. And this is where you got to listen carefully. What are the two aspects that go in here? Let's see. Number one, any income and expenses from related to raising of finance. What do I mean by that? When you want to issue some debt, take out some loans, will be part of financial instruments. Everything linked with that raising of finance, meaning the effective interest that you have, the transaction costs linked to those elements, the de-recognition of those loans, the fair values, if you are doing some fair value of certain loans without going into too much detail, all income and expenses, not only the interest expense for that, it says all income and expenses related to raising of finance, and which you probably still knew, but now it's clearly defined that when you're raising finance, if raising finance is what you're doing, everything linked to that raising finance is going in financing activities. And mind you, before that was not the case. Some of you are saying, oh, that's the same thing. No, before it was only the interest element. Now you have everything associated with those debt elements going in there. So that's the first thing. Second thing, which the standard clearly highlights, is the interest. Oops, highlighted it a bit too much. The interest income and expense that you see, let me just change the color so we can see it a bit nicely. All the interest income and expenses arising from apart from raising finance. What does this mean? You know, sometimes when I teach this in our sessions, it's like you read it, you're supposed to know English. But it's sometimes the way the accounting standard is written, right? It questions your own English ability. It's just the way it's written like a law. So that's where hopefully my job is to be able to simplify that for you. So what does this mean? Things like decommissioning provisions, things like, if you remember, some lease elements, things like when you think about the contract liabilities. If you see any of those elements there, what goes in this element is another example, pensions. When you think of pension, net defined pensions for those who might deal with it. So any change in the interest element for that. So that is specifically interest element regards to those liabilities. So the first sentence was for debt instruments, everything linked to that. Second element is when you have things in this scenario, like, for example, those provisions, the decommissioning, when you change, unwinding, increase of those provisions related to interest, when you have the net interest cost linked to the pension, all of those aspects now are going in this financing activities. So it's not about, in the past, there was no specific place where this unwinding went. Of course, people put it there in financing interest, but But what I said, there was no specific element. People are putting things in different elements. So the third category, financing, two elements go in there. And a nice way to think about that is elements linked to liabilities are going in this financing. Building it up to that second category that we have is that investing category. Think about this as it's like nice to think about like this. Think about this as like that assets element. Think about this as that liabilities elements, although it doesn't say it like that. These are more understanding when you read it more and more often. Okay, how do we break it down? Of course, I teach this as an exam. So I of course, try to learn tricks of how to make it easier for people to remember things also. In terms of investing, now this is also very clear what goes in here. So all the income and expenses related to three items. What are the three items? Number one, anything to do with when you have associates and JVs. I don't know if you remember associates and JVs. Associates and JVs are equity accounted, single line accounting. Don't scratch your head. Some of you, I can tell, some of my students probably said, ooh, I don't know equity accounting. That single line accounting, if you remember, the share of profits of that. Remember the share of profits, the equity accounting element. Those elements go in this investing activity. When you have some interest income linked to some additional amounts in the bank, cash and cash equivalents, interest linked to that, interest income linked to that goes in there. And the third thing that goes in there, it says here things that generate a return independently, meaning let's take the example of, say, investment properties. Investment property can generate, and your business is not investing, remind you, on its own, like its own cash generating unit. It can generate money on its own. It's not like PP where it requires other elements to help generate the revenue. Things like investment property. So fair value gains and losses of investment property will be going in this investing activity. If the investment property is held at a cost model, for those who might be aware, cost model, fair value model, the depreciation linked with that will go here. So you have the investment properties that are going in here. Any investment in those shares, when you invest in shares, when you invest in debt instruments, invest in bonds, these are also independent of the business per se. They can generate returns on their own. So the income and expenses associated with that is going in that investing category. And you can soon see, you said, okay, there is quite a lot of change that is happening. And for those who might be sad there, it's not only just the presentation. For those who are very well experienced, whose systems work accordingly, think about it, guys, your tagging systems, your GL ledgers, your codings. Some of you might not know what this is, but for those who are aware, things that flow in a certain way, how your financial information flows, how you make your reports, how you present your financial statement, that's a fundamental change, which you need to think about now. And the final element is, which is where it gets the actual interesting bit is, and I'll be very honest, the first time this came up, right, when I read it, when very quickly I said, oh, wow, new standard, amazing. First bit was, I will, oh, easy. I know operating, investing, financing from cash flow. When I read more, I said, oh, it's actually not that. Then I read operating. Then my second thought was, oh, I know what will go in operating, but it's not the way the standard is defined. What goes in operating is not per se defined. Operating is the residual or the remaining or the balance category, if you ask me. So the concept is you got to populate like bottom up in a way, populate everything that goes in that discontinued tax, financing, investing, and then the residual category or the remaining category, everything that was not defined in that. So anything, think about it. Still revenues, purchases, your employee salaries, your PPE depreciation, all of those aspects, dedeclination of that, all. If you're talking about all those aspects, they are still hitting your operating activities. Don't forget that. But it's like everything else. And because the other definitions are tight, right? You cannot really choose what goes in operating. Everything else gets dumped into that operating. So that's a lot to consider. I'm just rubbing this off so it doesn't get messy. Of course, I got a bit carried away, as you can see. I'll try to rub it off. What I wanted to highlight within this also is the fact that when you are doing this, you are, of course, there are these subtotals which you need to be aware of, which is the second aspect that you need to be completely aware of, that not only are these categories changed, we now have some subtotals as well. What do I mean these subtotals? Let's highlight these subtotals. The first one being this operating profit or loss subtotal. If you see here in this A, you must give these mandatory three subtotals. You can give more. It doesn't mean you don't have any more gross profits, but you must give these three subtotals. Operating profit, second being the profit before financing and taxes, and finally, the profit and loss that you see. So these are the three mandatory subtotals that need to be applied. Okay, so lots to digest. Hopefully that does give you some understanding as well. This is, of course, as you notice, I didn't want to just randomly go through the slides. Instead, what I did was I just took all that data and just planted it into that particular slide. It's the same information that we did. What is operating, what is profit before finance and taxes. And what I wanted to show you for all of your reference, I've taken this from as a source reference from the ACCA as well. ACCA's website, is they've given a nice performer of what something would look like, right, moving forward. Uh, so if you notice here, if you can see here, this is your operating profit and loss. Doesn't mean nothing really went in there. Of course, a lot of things are going in there. Just because I said residual category doesn't mean things don't go in there. You can still have the gross profit total like I told you, but the mandatory total is this operating profit. Of course, there is a little bit more talk about how do we aggregate, disaggregate. You can show things based on their nature, function, all of that is there. But I'm saying very interestingly, you have those elements that are very much defined. Look here, if you look here for the second category, which is that the investing element that you see here. Again, you can't, there is lots of us, at least having worked as an auditor also before, I remember this other category was very, very commonplace. But even if you write other, firstly, what you can write in others is very, very much controlled. You should not write other elements. Even if you wrote other, you should clearly define what that other element relates to, other investment income or other finance costs. So this notion of just putting things in others is no longer valid in this IFRS 18. Finally, you have the financing like we were discussing, if you recall. Yeah, so the interest expense relate to those borrowings, these liabilities, pensions and provisions element. Then you have self-explanatory, the tax and the discontinued. Of course, you can have some additional subtotals, but at least those three totals, I'll reiterate: operating profits, profit before financing and tax, and the profit and loss. And this helps you hopefully visualize something that I was trying to see. Jay, it's all okay? Any questions? I think we'll take the question at the end, but just want to know.
Yes, all's well, yeah, Nikhil.
Sure, perfect. Okay. So, like I said, just to we'll of course do some questions also in a while, but I'm saying just to make you think about some elements, please. Whilst we were doing these conversation before, right, in the olden style, people said, okay, depreciation will go in operating, for example, or impairments will go in operating. Now, under the new system, in my conversation that we were discussing here, if, for example, you had something known as this investment property, if you have an investment property, I just want to show you the kind of things that it might be very subtle, but they need to be very well thought about. Think about an investment property. Suppose it's following the cost model. Because the investment property is under the investing category, and anything which we are related to that investment property, whether it be the depreciation, whether it be the impairments, those elements would be going in this category of investing category. Whereas when you talk about a PPE, a property, plant and equipment, the depreciation linked to that, this is, remember, doesn't generate returns on its own independently. It's part of that organization. It's a residual category that ends up in that the PP elements end up in that operating category. So the depreciation, the impairments linked to that will be in the operating category. So I'm just giving you one of an example like this, that you got to be careful that not everything you can dump. Depreciation will be here, impairment will be here. You got to be very careful because of these new classifications. By the way, this slide talks about exactly what I did, but I just didn't want to go through the slide. I wanted to show you on that diagram basis. Okay. Another example I would like to quote just for your understanding also. Think about pensions. Now, maybe I appreciate some of you might not be doing pensions as much, especially the net defined pensions. We do it in our SBR classes for sure. At least one who's studying for the exam, they know it probably very well. These are one of those topics you study very well in the exam, but in real life, the practicality of that is very less, at least in this region. I'm not saying it's not their pension, especially the defined benefit scheme. The contribution definitely exists. So for those also, I know some of my students are also attending, so maybe to give them some flavor as well. So think about pensions, right? Traditionally, again, in net defined pensions, for those who might not be aware, these are, you need to have an actuary to help you value this. You need to record this liability in your books. You need to record the movements of these net liabilities. You record a net pension. You analyze what the pension fund's assets and liabilities are, and you record the net figure in your books, usually a net deficit. What I'm saying here is now the interest element linked to that pension, especially that net interest cost. You usually have a net defined pension scheme. There is a time value of money. You want to increase that. That would go in your financing category. Whereas the other elements linked to, like the current service cost, just for your awareness, current service cost is basically the increase because people have worked an additional year. These pensions are based on the number of years that you worked. This would go into your operating category. And the reason of saying this is to show you the subtleties of these elements that you must be aware of also. Okay. And like I said, this is just a summary of everything that we had spoken about. Something to please keep in mind, and maybe this would come up in anyways in a question form, is the standard, like with everything, is very, very fair and trying to achieve something, and especially from an investor point of view. So one of the key things that they do say is, if, for example, you are trying to, what if, for example, I told you all these 5 categories, great. But what if my real business activity is investing? What if my business model genuinely is to invest in these in shares, to invest in these instruments, to make a return through these investments, especially for those senior professionals who might be working in these sovereign wealth funds like ADIA, like Qatar Investments, or other international hedge funds or asset management firms. How would things work for them? Now, because they're real, and this is where the exception lies, if your main activity is considered investing, in that case, all those examples, everything that we were talking about, meaning your dividend incomes, your interest incomes, your fair value adjustments, management fees linked to that, all these items now, instead of being shown in the traditional investing activities, this would now be classified in that operating category. Why? Because this is your business. It is your business now. It is defined as what is your core business activity. And like I said, like those investment firms, etc. So if you are working in those firms, not to panic them. It's not that suddenly they are now having to show those elements in investing. If that's your business and that's been clearly defined, everything linked to that will now, instead of investing, would be in your operating activities, which might be anyways the case. But I'm just saying, just because a new rule came, doesn't mean you need to start panicking about that. Similarly for banks, if banks, what is bank's job? Bank's job is to give money, lend finance, arrange all of that. Then that is not part of their financing activities. If there are elements linked to loans, etc., then that is their operating activities. Again, today's session is not to go into those details, especially for those. My advice would be, if you are an investment entity, if you are a business like that, there is naturally a lot more reading of what are the exceptions, how they apply. But this is the theme that at least you can take back a flavor. And let's see, by the way, I want to see if you could tell me where would all these elements go. I'd said here your time to wake up, but probably you're already awake. I hope so. So in this is a BlackRock entity, asset manager, basically, huge company in the world. And what I was just trying to show you is traditionally you might have said, hey, these things like investment income, things like your fair value adjustments on investments, these might be reflected within your investing category. But under this IFRS 18, if this is your business activity, then these elements will be shown under the operating, which is what I wanted to highlight. And naturally, it's not, please mind you, it's not just a random element that you can, of course, do. You need to make sure, be very clear about what your business activity was, disclose it, talk about it. You can't keep changing it year on year. Why? Because you can't say, oh, this year is my this activity, next year my business activity is changed. There has to be a lot more description for it. But just a snippet in your mind that if your business activity is investing, then there is an exception that does apply to everybody. Okay. Hopefully you are hanging in there. Yes. Okay. Few more elements, and then let's see how much you were listening, because I have a nice uh, polls or question or quiz, I can say, to just give me more feedback on, did you really understand what I said, or you were just going through the motions. So what do we talk about here? Again, a very uh, slightly challenging topic maybe, but it's something again of importance, and that's what I wanted to address. I'm talking about the Forex elements under IFRS 18. So we know there are these 5 categories. I hope you remember that: operating, investing, financing, tax, discontinued. What this is trying to say, and again, this is a big change. Traditionally, we just lumped in or dumped in these Forex elements in one heading, Forex gains or losses, and we never really thought much about it. But with the introduction of IFRS 18, what has changed, and this is where I said people who are working in these, who have to tag their accounts, the codings, etc., this is where they have to be very careful. The standard says whatever the nature of the transaction is, based on the nature of the transaction, the Forex differences follow that. Meaning, ask yourself, where was that item recorded? Where does that item relate to? Does it relate to discontinued? Does it relate to tax? Does it relate to financing? Does it relate to investing? Or does it relate to operating, based on the analysis we did? The answer to that will give you the answer of how the Forex difference should be accounted for. For example, think about like when we buy and sell goods in a foreign currency, right? For those who might be aware, we might be in UAE, AED is our currency. We record everything in AED, but it's not natural. It's very natural that we have sales and purchases, payables, receivables in currencies different from AED, right? So whether it be pounds, euros, rupees, etc. Payables, receivables, purchases, sales are all that operating category. So any gains or losses linked with that will be also shown in the operating category. That's one example. Think about foreign subsidiaries. Foreign subsidiaries or investments. You have foreign investments in foreign currencies. When you're retranslating them, because those are categorized as investment categories, all the forex gains or losses linked to that would be in that investing category. So I'm saying it's not dumping it all in one. It's like following where that particular transaction was recorded. If the transaction was in operating, the forex linked to that will be in operating. If the transaction is in investing, the foreign exchange linked to that will be in investing. And naturally, with the final example, if you have something linked to your financing, that leasing, debt, because those are financing category, the forex linked to that will be in the financing category. So there you notice that, wow, within these forex as well, it's not that straightforward as tell me where the forex will go. My answer is where the transaction is going is where the forex is going as well. So like I said, on the face of it, it's straightforward, but lots to still think about. Okay? And hopefully you're able to digest a lot of this information, right? And like I said, guys, it's also more, these are more triggers to, I would say, to get you excited. Maybe this doesn't excite you and this bores you, or this really stresses you out, but it's those triggers to at least start saying, oh, okay, let me go and read a bit more about this. Yeah, naturally, with all due respect, in a 40-minute webinar, you cannot learn everything, right? But you can at least take back some information that hopefully that's the end goal, that can be some worthwhile for you and value addition for your time spent here. So two more elements. I'm almost there. So just a bit more. Last push. 6-7 minutes. Come on. I told you when we started that the cash flow, I told you, don't equate the same activities, operating, investing, financing, into the cash flow. However, with the introduction of IFRS 18, there has been some updates to cash flows as well. And I try to put things in diagrams, etc. It's maybe my teacher bit coming out always, but you don't have to do it in diagram form. If I were you, I would basically take out three key aspects from my conversation on cash flows. Number one is, let me just write this for you, get a nice color pen. Number one, under the new category, we now start the cash flow with operating profit. Where do we get that operating profit? I hope you remember. I hope you guys remember listening to this conversation from here. It is that operating profit that we start with, not profit before interest tax anymore, but the operating profit that we do start with. So that's the first big change. What that leads to is the second change is watch out for the non-cash items then you might be adjusting for. So an example is the share of profits of associate. Before you started with profit before interest and tax, it was part of this, so you had to minus it off or deduct it off. Now you're starting with operating profit. When you're starting with operating profits, these elements are here below it. Share of profits of associate. So why do we have to adjust for it? So I'm saying that's one example, but think about the other examples that might occur as well. That in the sense I said, take three things out. One is you start with operating profit, so that naturally is a starting difference. Second, most interestingly, the non-cash items will of course get impacted. And the third biggest change is traditionally this interest and even dividend, but for that matter, interest paid was given a choice, if you remember, right? You either put in operating or financing, even to do with that, for that matter, if you really looked into interest received or dividend received, but it was more the interest paid, if you ask me, was this choice. That choice no longer exists. It now must be in that financing category. And this is something that, of course, can change the analysis. People who are working in banks, valuations, etc., what you're getting as cash flow from operating, from financing, from investing, there has to be a little bit of adjustment in that also. So hopefully you take back that conversation from there, that there is that element of change there. Final element, and this is where, of course, there's a lot more guidance that is still coming up, but I felt it would be incomplete if I don't do the session by just talking about these management defined performance measures, or MPMs, some we call it additional performance measures, or APMs. What are basically all of this? This is also a big update in terms of, remember I started by saying the transparency element. What are these management defined performance measures? Are these subtotals, income and expenses, adjusted profits, people quote about, EBITDAs people talk about, adjusted EBITDAs people are talking about, right? This is what the traditional way is that people are reporting and talking about this in their management reports, in their communications, etc. The new standard IFRS 18 comes up and says, okay, great. If you have come up with these subtotals, these are not ratios, by the way, these doesn't include ratios, etc. These talk about subtotals, income and expenses, like adjusted profits, adjusted EBITDAs, etc. If you are talking about these, you must now, number one, go and clearly define what they are, tell people what they were and why did you choose that also. That's where it'll be very interesting. Why do you feel this is the better representation of your business? So, it's like a joke, unfortunately, sometimes people say, no, no, no. If you see these memes also, no, no. Are you profitable? Someone doesn't answer. Are you profitable? No, no, my adjusted EBITDA is profitable. Oh, I'm asking you, are you profitable? Answer the question. So it's like getting to that point that people adjust for it for many items and they say, yes, we are profitable, but are they really profitable? So this will hopefully stop that you got to define what these are. Why do you think they're important? Reconcile it to the nearest IFRS subtotal that we have learned, operating, PBIT, or their profits. And of course, you got to keep it consistent year on year, but more so, they are now even subject to audit and director sign off. So all the auditors sat there, a bit more work for you guys to do as well. But there's a lot more in this space that is needed for us to explore as well. But it was something I want you to keep in mind, that you might see a change or something that you need to keep working on this as well. So I'll stop speaking there. I'll of course want you guys. I want Jay, of course, if you don't mind, to put up some polls and questions, please, if you don't mind, to see whether any of you understood what we said also or not. And then, of course, feel free to put up your questions. The last 10-12 minutes I want to spend trying to answer those questions. Of course, with a disclaimer, I'm not, it's not professional advice. I can only give you from my understanding of the standard that I do have. And thank you again for listening in and trying to at least engage as well. Yes, Jay, if you could just get the questions, please, if you don't mind. Thank you, Jay. I think, Jay, so we put up each poll and then we just wait a minute or so. Is that correct?
I think people are responding, Nikhil. Can you see it on the chat?
Yes, I can see. Correct. So, Mohammed Tayyib, yes, early adoption is possible. It is possible for that, but of course, there's a lot of work to be done for that. Technically, it's from year ended December 2027. It says from January 27, but period endings 31st December 2027. I can see quite a few responses come through. Let's see. Investments in associates and JVs are accounted in which category? I promise I won't pick on you, but at least make an attempt. Okay. Sandra is not able to see the poll. I think you have to log in. I think that's probably the reason why I feel. Okay, so let's see uh, let's see the. Okay, so 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 let's see the poll. And yes, very correct, Ashwin, Mushraf, that you need to restate the comparatives also when you initially do that also. Correct. Very good. So great. Let's see the poll answer. So if I can just view the poll, that's what I need to do, right, Jay? If I can just view the poll, am I right?
Yeah, you can just view the poll and you can see the answers. Are you able to see the
Yes.
responses?
Yes. Uh, 1 second. I'm not able to see the responses, the answers that came in there, but at least the answer that there. Should I just give out the answer because I can't seem to see the answer
Yeah,
that.
you can give out the answers. Let me just share my screen. Let me just share my screen with the
Sure. If
answers.
you could do that, that'll be uh, lovely. Then I can show everybody as well.
Yeah. Are you able to see the screen?
Yes, yes, I can see the screen. So you got all these.
This is okay. I think it's better to just see it from here.
Yeah, yeah. So I know I can tell them the answer, but I just want to see where most people got it. So most people seem to have got it correct. Very good. That investment in associates and JVs are accounted, as you know, in that category known as the investing category. Fantastic. If we can have maybe one more, if you can just add, a few more questions, we can add the Jay, and then we can take some questions from everybody.
Uh, do you want me to add a new poll or you want me to show the
Just just the next question in the poll, if you don't mind.
yeah, investments in associates and JVs that are equity accounted are in which category?
So this one we just did now. So the
Mhm.
next one, I think if you can just put it on the next poll as well.
Yeah, for foreign. So everyone has already answered. It was like a quiz, so everyone has already answered.
Okay,
So
for all
you
the
can see.
answers elements. Okay,
Yeah.
okay.
So the third one was foreign exchange gains or losses are
Right.
always classified under financing activities in IFRS 18.
Correct.
Uh,
So that's absolutely good. Good. That was a tricky one, guys. So forex gains and losses, as you know, the answer is false because it follows the category. Uh, it relates to the transaction. It could be financing, it could be operating, or it could be investing. Yes, if you could.
the next one is if an investment entity earns interest income from debt securities under IFRS 18, it is classified as.
So it was a tricky one, guys. Usually it would be investing, but because if the business model is investment entity, like those RDRs, like those investment funds, then those elements should be categorized in operating category.
And the last one, most of them have gotten this correct. Under IFRS 18, management performance measures need to be audited and signed off by directors.
Yes, so absolutely. As you know, now the management performance measures, those APMs, those subtotals, which you are writing adjusted profits or adjusted EBITDAs, you need to get them audited. They need to be signed off as well. So a lot more responsibility on that. Thank you so much, Jay.
I think there are some questions, Nikhil,
Yes, I'm
on
just checking.
the.
Yeah, yeah. Harun, I'm not certain on that. I've not seen anything specific on that. You'll have to do a bit of reading on these NFBFCs. But it talks about banks and financial institutions whose main business activity might be that. Then those elements that would traditionally go in financing would be categorized in operating categories. Thank you, Jimmy. Thanks a lot. Jay, people asking in terms of would they be sharing, will be sharing these slides with them after this?
Yes, we can share the slides after the webinar. Nikhil, there's some questions in the Q&A section, so that's something that we have picked up and then posted it there. If you feel that's not.
I will look at that. Yeah. I'm just having a look at the Q&A section. 1 second. Just having a look 1 second if I can see. So Fahim, yes, Fahim asked about the comparatives being restated. Yes, the comparatives also need to be restated. So Abdul had a very good question. What happened in the case of consolidation? So this is, of course, case by case. You'll have to go. The challenges, you have to see the business model from a reporting entity's point of view. So what can happen is maybe your subsidiary entities might be showing things in a different category. But when you're, of course, reporting from a consolidated level, Abdul, you have to, of course, see if the reporting entity's main business activity, suppose, is not investing or not giving out finance, then things will have to be recategorized. So when you're doing the consolidation, you have to be careful. You have to rework or rework those financials to be able to do the consolidation. So that is a challenge that does exist. Zaka is like his, hopefully the cash flow will tie, but cash flow is not the same as there is, of course, the definition that different in the cash flow as compared to the IFRS 18 income statement. Is there any more questions? Because I've answered everything on that, Jay. Anything else?
I think there's a question from Ram Kumar also in the Q&A section. How the hedge on commodities and financial assets in different currencies will change in new IFRS 18.
So again, there are multiple aspects of that. One is that I would again recommend you in terms of the hedging, there is, depending on what the instrument is, uh, it follows the nature of that. If the instrument was going in financing, investing, for example, the hedging element of that would go there also. If not, if it's in the residual category operating, it would lie up in that operating category. There is a little bit more talk about embedded derivatives, breaking it up, which of course is not the scope here, but there is a lot more which is there. I would advise you, is what you could do is, I at least do that as well, in terms of I take any of these audit firms without trying to promote anybody, but I personally use a lot of the BDO kind of information. Grant Thornton have BDO, KPMG, EY, but especially I've been using BDO for the last 4 or 5 years. They have a very nice couple of 150, 60 pages document exactly on, oh, this is the example. What about the hedging? What about the Forex? And you can go and clearly go and do that. Yes, absolutely, Harun. So the effect, it's starting from period ending of 31st December 2007. But yes, you're right. The comparatives also would need to be restated. So there is a lot of work that needs to be required as well. Wasim, there is no skipping that you can do. OCI still remains as it is. What has changed is the profit. The subtotals have got updated. The categories within the profit and loss have got updated, but the OCI remains as it is, and you can't skip anything from my understanding. So again, Musarrad, your normal bank charges will be depending on what those bank charges are. If they're related to those raising of those finance, they would be in the financing categories. If not, things end up in the residual category of operating. So yet again, that would be in financing, Arsalan, from my understanding of that, that elements linked to that lease liability, the interest element of that would be in that financing category. If it doesn't meet any of that definition, automatically things end up in the residual category. Everything else, Wasim, which is amortization, all of these elements are linked in that. operating category that we have. So from what my understanding is, Raghavi, the management, there is a lot more that is required for this. There's of course not everything that is out there on management defined performance measures. This is just the understanding that if that's the case, you need to have those audited. They need to be, there's a little bit more, you can't just talk about those disclosures or those notes just on its own. There is a lot more that goes into that. And guys, I can't be, there's too many questions hitting. It's as you understand, I'm not an advisor for you guys. So that's something you'll have to research, get your advice from that. This forum is not for advice per se. It's to give you the understanding of, hey, this is what it looks like. Yeah. Gautam, wonderful to connect with you. It's been a long while. The OCI category, Gautam, would go in the other comprehensive income, which still sticks there. Okay. I think Jaya, in terms of, like I said, I don't want to, from this platform, wanting to be giving advice per se for every transaction. I think that's not the purpose. So I think maybe we could call it an end there, because I think the purpose is hopefully met, that people have got an idea of what that is and how it should be dealt with as well. And thank you guys for listening, interacting, and really appreciate your time as well.
No, I think thank you, Nikhil, and thank you all for joining us today and for your active participation. And I'm sure, all the insights that Nikhil has shared today will help you navigate the latest IFRS developments and stay connected, stay informed, and all of you have a great evening. Thank you so much. Bye, Nikhil. Bye-bye.
Thank you, guys.